The next big short opportunity is about to set up, and the only thing you have to do is not blow it by holding onto a long filled with nothing more than hopium. And don't get it twisted, there's absolutely a counter trend move available here, and if you've been watching the market carefully, it's quite clear what the next steps are. Nothing overly complex in tonight's episode. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY weekly time frame chart. And I want you to recall what we talked about in the Saturday update video, where there was certainly the possibility for a weekly trend reversal based on this double top formation here. Now, of course, we all know that a double top is only valid when and if we bring in a lower low by breaching the neckline of the pattern. Now, what I want you to focus on before we get to the neckline is, where did we open this week's candle? We opened inside the previous week's range, but not just inside the previous week's range, we opened in the upper half of the previous week's range, which is slightly more bullish than it is bearish, right? If it was weaker, we would have opened towards the lows of the previous week's range. That wasn't the case. So we have to imagine here that a stronger market would have opened in the upper half of the previous week's range, and it would have tried some attempt to find the previous week's high, and heck, maybe even try to set or establish some sort of bar-to-bar higher high. And we can clearly see that wasn't the case. Obviously, on Monday, there was a near straight shot move to the downside through the lower edge of the weekly expected move. Now, I'm not going to sit here and tell you that we have a confirmed weekly close underneath the neckline, because of course, there's still 2 trading days left in the session, the weekly session that is. We've tested the neckline, but the point being on the higher time frame weekly chart is simply to say we've tested underneath this level. A stronger market would not have tested the previous week's low at all. It would have opened in the upper half of the previous week's range and attempted the previous week's highs. It would have stayed far, far away from this neckline of the potential weekly double top. So again, this is a warning shot across the bow. This is not a confirmed breakdown or trend reversal on the higher time frames, but the lower wick puncturing the neckline of this pattern, once again, is a warning shot across the bow. A stronger market would not have done this. If we take a look at the daily time frame chart, we can start to explore that Monday breakdown a little bit more. I think it's very telling that the exact high of the day's session was right to the daily 50 SMA. And mind you, we opened on a subtle gap up over Friday's high of day. We saw a little attempt higher and promptly a fade back to the previous day's high, Friday's high, through Friday's range, setting a new low under Friday's low, a bearish engulfer at one point during the session. Very, very bearish day, straight to the lower edge of the weekly expected move. Tuesday, of course, even gets some follow through underneath the lower edge of the weekly expected move. And the way I would frame this potential move off of the daily 200 SMA, that's the green moving average on your screen here, is not so much that new money buyers are stepping up and buying this at the daily 200, it's that shorts are actually slowing down at the daily 200. They're slowing down with this extension through the lower edge of the weekly expected move. Shorts with terrible location down here at the daily 200 are the ones who squeeze out and cause the counter trend move. It does not necessarily look like, to me, we have new money buyers stepping up at the daily 200. If you come to me in the comments and you say, I was stepping up at the daily 200, I was buying that down there, well, I hate to break it to you, but you're probably not, air quotes, big money. So let's talk about the potential for this daily trend to continue in the downward direction after really all we've done on today's session is produce an inside bar. I mean, you want to talk about everybody over the moon. Oh, look, we finally started to find a bottom. There's some green upside. There's some green shoots. Yes, I'll acknowledge that we didn't make a new low during today's session, but we also didn't make a new high, and there's plenty of opportunity for overhead supply to persist on the daily time frame view. And the next major level, where I think that the next major short, the big short, as I mentioned in the introduction, where I think that's going to set up is on a possible retest of 590.25. Right? If we're counting the daily trend, we have highs, we have lower highs here at the daily 50 SMA, the gap up open from Monday, the small follow through, and I shouldn't even say small because these ranges have been massive intraday, but the follow through from Friday and the gap up on Monday does achieve a short-term counter trend, hourly uptrend there. We'll see that in just a moment. So this is the next lower high in the sequence. That means this was the low. Obviously, we've made a lower low as of Tuesday's low of day, and the next counter trend lower high can be set anywhere underneath 590.25. And what does that continue to suggest? All of the traders from this box up here remain our new favorite acronym, OHS, overhead supply. Anybody who's still long this market from up here, remember DeepSeek, remember tariffs, remember CPI, anybody who's still long the market from up here may try to escape break even if they haven't done so already at 595.85. They may try to do so here at the dead on the lows of the tariff gap down that day, which is at 590.25 and also aligns with the Tuesday low of last week. And we'll see this on the hourly chart in terms of structure in just a moment. It's the CPI gap area from back here as well. So a lot of confluence, a lot of reasons to believe that 590.25 is going to be a battleground for the market as we move forward. And I want to just emphasize one more time, there is the possibility of a counter trend move in the upward direction to get there. I think there's a long opportunity here for a scalp in the upward direction to tag 590.25. And the reason behind this is that we do have an inside bar on the daily time frame, where clearly sellers again ran out of bullets, smack on the lows of the move, the daily 200 SMA. But then, more importantly than that, we ended up closing over the opening print of the prior day's session, even after backing off of this high just a little bit. So to me, that's quite telling. On the daily chart, I do want to check in on our Fibonacci retracement one time here before jumping on down to the hourly. And lo and behold, what do you see here? It's not going to be perfect confluence, but it's pretty darn good at the 590.25. If this is going to build out bear flag consolidation, anything underneath that 38.2 classifies as bear flag consolidation. Once again, it's within spitting distance of 590.25. I mean, 2 points on the S&P 500 has been going by in the blink of an eye in these current market environments, in these conditions, right, with the volatility through the roof. So potential for a counter trend lower high happening here. Looking to short the market if we see a valid intraday setup back to the downside and ballooning runners towards the equal low, another retest of the daily 200 SMA. If we have a big time lower high in the trend count up against 590.25 and then we come down to the equal low at 573 down here, the lows of the Tuesday and today's Wednesday session, a reattempt through that, right? We should be looking for an equal low breakdown to continue the trend, in which case the next major level to the downside is 566.15. Just a little bit of a zone here, 564.65 as well. And I do want to zoom out on the daily chart just to show you where that's coming from. It's a big retest of a weekly breakout level, right? This could be construed as a weekly double bottom. It's sort of pie in the sky. You could call it ascending triangle if you do something that looks like this. Doesn't matter what you want to call it, but that's the next major retest area around 566.15. Flat top resistance, acted as support above it before the election gap and go. If we come back to that level, it wouldn't be unreasonable that buyers try to make a stand there. Again, this 200 SMA, this to me is more like sellers running out of bullets, but buyers structurally should have more of an opportunity to respond off of this technical level. It's a structural element, right? Let's take it on down now to the hourly chart so we can see this with a little bit more detail. And again, very clean example of follow through to the downside with bearish structure, right? Where you have highs, lower lows. I mean, we can walk through all of these examples, right? Lower lows, equal lows. We talked about back here how if the buyers were going to make a counter trend move happen, this should have been your double bottom. Obviously, the follow through then gives leeway for another lower high and the trend count continues, right? So now, as we see this from the hourly perspective, right, the pattern traders say, okay, great, we have a double bottom happening at the daily 200 SMA. That's the green moving average still towards the bottom end of the screen, in which I would say, sure, absolutely no problem. If we see tomorrow a move over the inside bar high, which aligns with, classic inside bar rules anyhow, when you're thinking about this is ultimately just a multi-day balance range, if you break over the balance highs, then fine. We can look for this counter trend move, and we just talked about this, for risk reward along these lines. But you bet your bottom dollar that when and if we approach 590.25, if there are any signs of sellers stepping up at this level right here, I will be looking for a short opportunity to continue nothing more than the hourly trend in the downward direction. We'll be continuing the daily trend in the downward direction, and it's very possible, depending on the weekly close, that we start to suggest the double top is triggering through the neckline. Depends on where the weekly closes, and of course, we'll keep you posted in the Saturday weekend update edition, okay? So that's my idea here. It's certainly that, this consolidation, fine. Double bottom with a higher low building onto it. You could start to call it cup and handle, right? If you wanted to call it a rounded bottom with a handle over here. Anything over the neckline, the two equal highs, no problem. I'm on board for the potential for a counter trend move to get to this 590.25. But to me, this is a very heavy level. Why might it be such a heavy level? We've seen it on the daily time frame chart. We know about the overhead supply off to our left, but let's even take it as close as the Monday session. Notice on Monday, you actually started to find buyers there. Recall that this was a spike into the Friday afternoon, that end of day rally, right? So anybody who was like, aha, this is finally going to be the end of the move. It's going to turn into inverted head and shoulders. This has got to hold as a higher low. Anybody who initiated new positions on Monday, who's trapped, stuck up here, who bought the suckers long basically on a gap up in a downtrend, that's a fool's errand basically. That move, those buyers, they're trapped. If they want out for break even, the closest area that they can start to do that is that 590.25. So I'm a believer that 590.25 has the opportunity to offer one heck of a rejection back in the downward direction. So how is the trend going to play out across the time frames? Of course, I wish I had a crystal ball. I don't, but I can give you the scenarios that I'm willing to respond to. Of course, as mentioned, this would be great. I would love to participate in the counter trend to get there. When and if we get here, I will be on the search, on the lookout for regular head and shoulders. We could talk about, hourly double top, 15-minute double top, inverted hammer. That's definitely got to be inverted if we're looking for the sell side. And then we'll retarget the neckline here at 584.75. I think that trade overall in a downtrend has some pretty high expected value to it, right? So that to me makes a lot of sense. Now, when we get here, I'm open-minded to buyers trying to step up and trying to turn this into a Man Ray pattern, right? Where we get some sort of maybe right shoulder to build out over 584.75. The only way in which I'm going to participate on the long side on a hold over this previous area of resistance, the only way I'm participating long there is if the market internals suggest that, oh my God, at the exchange level, buyers are stepping up. We have huge volume inflows. If value was clearly higher from the market profile up towards this 590.25, if there's more of an overshoot of this level at 590.25 and then we pull back to here, great. We'll possibly look for a long off of this level to build out a right shoulder, right? Maybe you have left, here's your double head for the Man Ray pattern, and maybe you build out a right shoulder. That's a possibility. But considering the prevailing winds and considering some of the supporting evidence that we're about to go through as well, I would really want to see much more of a bearish Brigade bolt back through the level, something that looks like this, to then rotate back down to the equal low, in which case we now shift over to the daily base case where we're saying, hey, an equal low reattempt after a lower high, and we're probably starting to think about that, higher time frame retest zone we just saw on the daily chart, right? 566, 564 as a little bit of a zone. So that's the main thesis, is right here, what's on the screen currently. Now, of course, let's not, ignore the fact that if the market does not play nicely, if the market does not put in a rejection at 590.25, any holds above this level, I would start to neutralize my viewpoint on the market. And then I think it becomes much more realistic that that higher low can be set. And then where's the stronger, more confident long? Over 595.85, recapture the daily 50 SMA, and now maybe you have a stronger argument that buyers have stepped up and we're looking for follow through to the upside. I want to be very clear about something as well, and we're going to go back to the daily time frame charts to sort of talk about this concept. As we're looking at that as a possible, inverted head and shoulders as such, right? Of course, the largest range that you could capture is if you're a buyer down here at the daily 200 SMA, smack on the lows of the move. But what I think I shouldn't even say retail gets too wrapped up in this. You don't have to nail the low, right? That's part of the idea about trading a trend, is that you take the middle chunk of a move. So I think something that gets lost in translation is if this truly is going to represent a bottom for a number of weeks, not just like a bottom for a couple of days, but if this is the bottom for the first half of 2025, goodness, forgetting what year we're in, and we're going to continue the rally in the upward direction and things are fine and dandy, you've got to imagine that the market should be on pace to take out the equal high and extend the gain for a higher high. Isn't that the whole point of building a new uptrend, is to go on to produce higher highs after establishing some sort of low? In my book, it certainly is. So, yes, is the value of the trade highest at the bottom of the move? Of course it is. But are you going to get an added layer of confirmation for an actual daily trend reversal if you're patient and diligent and waiting for a structural shift? Something along these lines. I'm just going to, loosely draw on that pattern, right? Although, yes, maybe we're looking for the long here, and anybody who bought it smack on the lows is maybe saying something like, look at you, you're chasing it so late to the game now. At that point, there's much more of a structural reversal taking place, and I can trust structure. I can't necessarily trust trying to buy, classically, catching the falling knife. So I think that's sort of the dilemma between the daily and the hourly here. And, again, to go back to the daily perhaps, and I know in the weekend video we solicited some feedback about, do you like the rants? And, the overwhelming feedback was, yes, we like your just raw thoughts on the market. Something to keep in mind is I don't want to be, and I'll reiterate the point from the Saturday video, I do not want to be any more bearish than I have to be. I'm not making this video because my top priority is to see my long-term holdings dwindle away off of some big lower high underneath 590.25. That's not the idea. I want to be just as bullish as the next person who has a longer-term viewpoint of the market and also the ability to trade it in the short term. But in the short term, I'm seeing a downtrend. I'm seeing a rejection of that daily 50 SMA. I'm seeing the opportunity for overhead supply to persist, as long as we're under that 590.25. I'm seeing the inside bar. I'm saying, okay, maybe sellers are getting a little tired down here, but really, there's nothing that has changed the trend dramatically yet back in the upward direction. So hopefully that's helpful. Hopefully the commentary there helps give you some insights as to how maybe you should be interfacing with this market. Let's quickly check in on the intraday anchored VWAPs. You can see here that if we were to get over this, right, we're above the low anchored VWAP here, as well as the Monday anchored VWAP, which to me is very important. If we're over that week-to-day anchored VWAP, it just means that everybody who is short late to the party into the daily 200 SMA is setting up to become a victim to the short squeeze into 590.25, which lo and behold, if you throw on the all-time high anchored VWAP, beautiful confluence, right? So the levels are all making perfect sense here as to what we should and shouldn't be looking out for as the week, sort of moves on. So there it is. That's your S&P analysis. Let's take a look. I think maybe one of the things we didn't cover, of course, is just any consolidation here, right, is just bear flag, as we've noted from the Fibonacci perspective. Brigade bullets underneath 573 should open the door to the downside. At this point, after an inside bar, I'm probably more willing to take this short, even though we're back at the daily 200 SMA. After an inside bar, we've had enough consolidation where I think sellers have caught their breath, and we can see that follow through to the downside, even if it's just an intraday trade for this next zone here into 566.15, 564, as noted earlier. Let's interrogate the market internals, because this is going to help us understand, again, that so far we have not seen new money buyers really step up. Take a look at the top video tutorial in the top right-hand corner if you're not familiar with this dashboard. For today's session, because there was we could argue that there's a counter trend move here. There's a little bit of an opening range, very sloppy, and we sort of talked about this in the pre-market prep, which was just this morning's open, absolutely horrendous, right? Nothing to do there, basically, until a low was set, and we found this higher low after setting a higher high. So anyhow, do we have new buyers stepping up at the exchange level here? Yes, the volume flows technically breach positive 300 million, and we are taking that into consideration. But was the advanced decline line up in trend higher zone all day? Or said another way, did this trend into trend higher zone and hold? It didn't. It actually made a move to the zero line. This made a move to the zero line and saw an end of day sort of squeeze, if you will. The index score was wishy-washy all morning, and the cumulative build out of the tick was actually negative on the session. So as I ask myself the question, is this an example of new money buyers stepping up in the market? To me, the answer is no. We do not have that clean trend day to the upside yet, where it's very clear that larger participants are sitting on the bid waiting for their fill at the VWAP. It's give, take, give, take, give, take, give, take, trying to beat that average price for the session. To me, both today and even yesterday, take a look at this move, right? After the morning washout, the move back to the upside, it was not brought to you by strong market internals, right? Look at the Monday session. Absolutely horrific, huge volume outflows. I suppose one of the things, instead of getting too wrapped up in today's session, were there stronger sellers on Monday? Yes, 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 over here on the cumulative build as well. Monday was a pretty nasty day, right? And it is being backed up at the exchange level with some stronger sellers stepping up. Same thing on Tuesday. Volume flows end up, closing out horribly. there. And of course, there's some tariff volatility, and we're not going to omit that. And, there's the potential for optimism around resolution or reduction of tariffs moving forward. And that news headline is something that's always going to be looming in the background. It's something that we want to have as a possibility, right? It's not something that I think we should be trading on heavily. We're not just going to load up longs here and say, oh, tariffs are going to resolve, market's going to pop higher, and everything's going to resolve. It's rainbows and butterflies. We're all friends, right? It's not really how, in my view, it should be working here. But it is a possibility to have in the back of your head, which, in my view, really suggests that you should be trading with a stop here, right? A hard stop in the market. So anyhow, that's your internals dialogue. Doesn't look like new money buyers. Looks like short squeeze off the lows once. Looks like short squeeze off the lows twice. Not really much more than that. Let's take a look at the market profile for the ES in particular. And this is one of the reasons why I think that the counter trend may start to take a move, or take us a little higher in the immediate term. I'm talking about like Thursday morning, right? If you're not familiar with market profile, check out the video tutorial in the top right-hand corner. Look at what happened with the interplay of the value area from the Tuesday session versus today's session, Wednesday. You can clearly see that value and the point of control migrated higher, even though we had that morning session where the market was just brutally sideways, right, for most of the morning, and then finally caught the low and then moved in the upward direction. So to see the value area and point of control migrate higher with price does seem to me, as mentioned on the daily chart, right, we were saying at the daily 200 SMA, it's more like sellers are running out of strength down here. It's not so much that new money buyers are stepping up, right? So to me, that is something worth noting is the value area shift there. The other thing worth noting is that technically, because we do have an inside bar on today's session, we still have a poor low from Tuesday. This lacks material excess at the lows. It's the improper end of the auction. So does that suggest that maybe we need to revisit it? I think so, right? So that is something we will carry forward as being weak, a level in need of repair. It's the low of the Tuesday session. In the ES futures, we're talking about 57.4575 roughly. Okay, those are the market profile interpretations to the upside. Not much to really read into here. We do still have very poor high back here, and I think that the general zone that we should be paying attention to, right, is 6,000. As long as we're underneath 6,000, it's totally still a bearish market here with another opportunity for nothing more than a lower high. You could even see a lower high form if we see a rally attempt in the upward direction here near the single print. It's not technically single prints. It's definitely a low volume void. It's a low volume node here from the Monday session. That's going to be around, let's just use this beginning of the 3 period prints there. That's at 59.35. We'll round up there. 59.35. At 59.35, which is also, loosely aligned with the lows here. It is the top of the single prints from this post. It is not quite the single prints from here, but any rally attempt over these highs on the futures to about 59.30, 59.35, this zone is where we're going to start looking for those sellers to reemerge, and that should align beautifully with, back over here, of course, our key level, previous lows, base of the spike. This is from Friday, Monday's low in the opening range, the anchored VWAP at 590.25. Okay, that's the S&P 500 commentary. Let's quickly jump on over to the QQQ NASDAQ 100. Let's see what's happening over here, and we will get this show on the road. I think that this is an even cleaner example of overhead supply persisting in the market. I still think there's an opportunity for a counter trend move. You can see that we still have that same structure. It's a daily inside candle where we have a lower high and a higher low. We're respecting the daily 200 SMA. We have not closed outside of the weekly expected move, which I find somewhat intriguing relative to the S&P 500. If we can take out 504, we're looking for the counter trend into 510, and at 510, lo and behold, that's your short opportunity for a move back down to the equal lows. You're looking for risk and reward back to the downside. If we breach through 510, as I was saying with the S&P, I don't want to stay any more bearish than I have to. So if we get a move for a higher low over 510, count me in. I'll start to change my tone to at minimum neutral, if not starting to seek new money longs on a move back to the top end of the range and perhaps all-time highs over time. We don't want to jump the gun, and as mentioned in the intro, the only mistake you could make here being under 510 and being under the 590 level we just talked about in the S&P 500 cash, the only mistake you can make is taking the counter trend long, overstaying your welcome at resistance, watching the market turn against you, holding on to that long position back to break even, only to realize that you have missed the short opportunity on the retest, right? The Brigade Bolt. Brigade Bolts go both ways. I always prefer to trade them on the bull side, but hey, These are the conditions we are operating in. 510, potential lower high, daily time frame chart, very, very clear here out of the QQQ. It is interesting that 500, this previous low, was not as well respected as I might have thought, especially noting if we zoom out on this chart, right? This previous area in here is pretty aligned with that 500 zone. If we take it on down to the hourly chart, we can see this chop and slop through it, where, yeah, into the Friday session, we started to catch it for a low there, but immediately breaking down into the close on the Monday session, not really rejecting it cleanly on the Tuesday session. Today's Wednesday was straight back and forth through it as well. I think the primary take here should just be, if this is an hourly double bottom for the counter trend to set up, we want to see acceptance over 500 for the next hourly higher low from here to here. A Brigade bolt through 504 gets us to 510. That's 6 points of upside to trade for on the counter trend, and then we're looking for the rejection off of that level to trade back down to the equal low, and that of course continues the bearish pressure across the market. We will make the concession, right? If we make it here, set a higher low, and then start to Brigade bolt over 510, that is where I change my tone right here. Not on this move, not on the first dot, on the second dot back over 510. Call me late to the party, call me whatever you want. I prefer to trade with higher degrees of confirmation, so my hit rate is higher, versus taking a move speculatively, trying to catch the falling knife on the lows. So just my 2 cents here in terms of how I'll personally be navigating the potential for a trend change if it's going to happen. Obviously, straight shot through it with acceptance above, we'll have to change tone as well. But the primary outcome I'm concerned with, or looking to trade for as the first idea up on the chopping block, is this. Right, there's your double top, 2 here, through there for the equal low, and then possibly monitoring for continuation in the downward direction. If we get straight up bear flag consolidation, it's exactly that. It's bear flag consolidation. It's another inside bar. We could check in on our Fibonacci's from the highs to the lows, and where is our 38.2? Basically spot on with 510. Not bad. Not bad. The levels are leveling. They are making sense. Let's take a look at the intraday anchored VWAPs. Right on from the all-time high, and we are above this to suggest, okay, if we can hold that into the end of the week, the counter trend is available. I want to be very clear. The counter trend is available. Just do not overstay your welcome at 510 in an overall downtrend. I think the message has been quite clear through today's episode. Let's jump on over to the NASDAQ internals. Thinkorswim has given me, oh, look at that, speedy load. Earlier on, like right after the bell, it was giving me some issues with the load time, so appreciative of that, Charles Schwab, thank you. Strong outflows on the Monday session, validating the sellers. On the Tuesday session, a little bit stronger of a move from a volume perspective to neutralize here versus the S&P, which we saw as being pretty weak. Today's session over positive 400 million. As we look at the advanced decline line here, brutal on the Monday sell-off. Tuesday's ramp only gets us 2-0 and fades into the afternoon, so again, short squeeze, not necessarily new money buyers stepping up. And for today's session, we get the test of zero line instead of a straight up move to trend higher zone for consolidation all day. Get a little bit stronger of a cumulative build on today's session out of the NASDAQ. I think the NASDAQ opportunity is a little bit stronger than that of the S&P 500, and we'll see why when we go through some of the core list of companies here. There's a number of trade setups in that core list of companies that, in my view, are maybe even more attractive than just the broad market index itself. So we'll get to that momentarily, but those are your market internals for the NASDAQ, looking okay, not bad. Let's jump into our NQ futures. Let's give this a little reset so we can actually see the value areas in point of control. I would just say that there's a divergence here, obviously relative to your S&P 500, where we have value area still lower in the overall session. Point of control is slightly higher, but relative to the session, right? It's not like value is dragged higher. And look at all the time spent. I mean, look at JKLM periods. You're 4 wide up here, and yet value area has not moved higher. It just leaves a bit to be desired still on the long side. So in my view, if we do get that counter trend move in the upward direction, I've been saying this like a broken record in the morning shows, pre-market prep every day, I'm being very careful with my words. This is a counter trend move on the long side in the context of a clear and established daily downtrend, hourly downtrend, right? And we don't want to overstay our welcome. So that is sort of confirming that with the point of control not moving higher, even though plenty of time was technically spent up here. Not a lot of transactions actually taking place. Let's go back on over to the platform. Let's finish up the broad market look with, of course, our good friend, the Rusty Rut. Let's see what's going on with our New Balance range. Of course, far, far away from that as of right now. Where are we relative to the daily 200? We're underneath, whereas in the other two indices, we are above the daily 200 SMA. So a clear sign of divergence here. We've been talking about small caps being divergent for a very long time. This is a bearish divergence, of course, and it's particularly alarming when we have a Fed tracker tool that is suggesting, hey, you're now going to get 3 rate cuts in 2025, and small caps continue to puke and fall off a cliff. That doesn't really give you a warm and fuzzy feeling inside and is much more reflective still of the recession narrative that we've been slowly integrating into the show over the last week and a half or so. The PMI number this morning, actually, from the ISM, the Institute of Supply Management, wasn't as bad as I was expecting, and that might put a little bit of pressure, or it might add into the idea that a counter-trend move here might not be unreasonable. So let's take a look at the IWM through the lens of the current price action. Of course, inside bar, indecisive doji from the prior day's session. I think like the other indices, there's still clean setups happening down here. It's very obvious as to what needs to take place next and where the lower highs are likely to form. Right? You have 214 as a big level. Any counter trend moves there suggest nothing more than a daily lower high. Any counter trend moves that go all the way up to 218, in my view, still offer a daily lower high. Something that looks like this offers massive overhead supply still from here down to here. It's also a rejection on the back test of the daily 200 SMA, the green moving average, as always, on our charts. We are extended through the lower bound of the weekly expected move with daily closes under the lower bound, unlike the QQQ. So for that reason, if we do need some air quotes snapback, if the rubber band got stretched too far, wouldn't be unreasonable, again, to support the claim that a counter trend move can happen first. Any consolidation that's weak down here as an inside bar will technically act as bear flag consolidation on the lows. The next downside target, just to make you aware of what we would be aiming at, is this set of lows from back over here. That would be at 198 underneath the big bad round number psychological 200. Let's move on down to the hourly time frame chart. And there's really, there's a couple of Fibonacci perspectives you could use on this chart. You could do something that looks like this, and you could say, okay, 38.2 is here, 214, that makes sense. 61.8, the line in the sand at 218, validating that level. You could also come in from the top of the week, and you could come into the low and say, all right, what do we have from this perspective? Is it possible that from no man's land, you get a counter trend move into 214, which is still not quite 100% retracement, but is that possible? Seems within the realm of capabilities, in my view. This, of course, is starting to look a little bit like a higher low double bottom, so you have that going for you out of the Russell. Instead of the equal low, you have much more of a higher low happening here. If the neckline is going to be broken, that is over 209.25. We are looking for a possible counter trend long. There's a couple of sneaky spots where this could easily act as resistance here, 211.65, and then beyond that, 214 is the next major level. If we come in with the intraday anchored VWAPs, we can see that we, on a break of the neckline from the double bottom perspective, we would be clearing the cluster just like we are in the other indices as well. And if we do get the full rally to the major daily level, it's 214 at the anchored VWAP. So that's checking out. That makes sense here. I think we have a logical approach to all of the indexes thus far. Indices. You tell me in the comments down below. What else can we say? Let's move along to the Russell internals. We'll notice that we did not have strong volume inflows on today's session, but we did have strong volume outflows on Monday. The advanced decline line did not make it near trend higher zone here, and we did still close out a flat and lackluster build from the cumulative over on the tick. The double bottom is quite clear also through the overnight high of the overnight session, for lack of another word there, which is on par with the high of Tuesday's session. So that's, sort of a double whammy, if you will, at the Tuesday high. Let's jump on over to the platform to look at the market profile, and let's quickly assess where the value area went from today's session. It is higher relative to the Tuesday session. Point of control is higher, and we do have a poor high on today's session. You can see the mechanical nature of the Tuesday high as well as the overnight session high there also, just validating some of the thoughts we were having. Shorts late to the party, especially based on this point of control from the Monday session. Those shorts are likely to squeeze, in my opinion, causing the counter trend move in the first place, as in if we break over Tuesday's high. So out of the small caps, Let me see what we did there. It is definitely Tuesday's high that you should pay attention to, right? And on the counter trend rally, let it go. Or even take the long. That's fine. But just don't overstay your welcome as we start to come into some of the heavy overhead supply, like 214 and 218 on the IWM. Let's jump on into the sectors and let's take a look through a deep dive on the sectors, because I think this supports the claim that we are still setting up for a lower high across the market here, a lower high, not some sort of miraculous recovery off of the daily 200. So weekly performance, then we'll check in on the structural charts. Leading the pack is healthcare, followed by real estate, the only two green sectors on the week. That is defensive, if I would not say so myself, because healthcare, of course, falls into that category. Real estate, hard assets, loosely in that defensive category. I would still say that headed into a recession, probably not. Rates coming down. We saw an anecdotal headline this morning about mortgage demand seeing an uptick. We'll keep tabs on it. And of course, maybe that's short-term impact on real estate. But if the dirty R word is truly going to come into view here, we're probably not going to see continued outperformance there. At the bottom end of the barrel, it's energy. So that's deflationary. I like that in terms of avoiding the stagflation conversation that the market maybe needs to have over the next couple of weeks here. Financials getting beat up big time, not good. That was acting as the backbone of the S&P 500, and obviously it's causing some of this severe downside here, down 4.03%. Discretionary, I realized I clicked on that. It's too early. I want to be back on the SPY there. Discretionary getting beat up, down 2.67%. Semiconductors, 2.5% plus. We have the technology sector down over 2%. And what this allows for, as we'll take a look through the structural charts, is major lower highs. So healthcare, defensive, fourth heaviest weight sector in the S&P 500. Yeah, it's trying for this inverted head and shoulders. We've been talking about that, but it's not the right sector to lead the marketplace back to an all-time high. You can get consolidation here, and you can get a push in the upward direction, and maybe the S&P 500 doesn't crash, but it's probably not let's go out and buy this market with both hands until we're also starting to see some participation and recovery out of semiconductors and notably the tech sector as a whole. Let's move along to real estate. It would be great if this could hold here. Nice little rally off of today's session as the market sort of saw that mortgage demand uptick. So we'll watch to see if that can hold true over 4270. It's a lightweight sector. It's not going to make or break the S&P. Here's energy rotating to the bottom end of its range. Not unreasonable that a counter trend move to the upside could unfold off of the bottom of the balance. It's deflationary if it can stay down here, and that might help some of the readings upcoming, but that's not included in the core read, right? Core CPI, core PCE, it's not going to include your volatile food and energy. So it's helping the case for inflation to come down. And of course, there's like ripple effects as to what energy impacts, but watching this closely. Let's take a look at financials, because this is where a conversation has to start getting a little bit more serious about the bearish implications of what's happening in the market, right? This as a balance range, trying to break out on the Monday session towards the high and failing at the blue sky territories after a recovery effort dipping below the bottom of the range, closing below on Tuesday, an inside bar today. I mean, how could you not be concerned after a failed breakout for a potential lower high and continued downward pressure out of financials? This is going to put the bearish pressure on the S&P 500. This is one of the reasons why I said that the lower high is the first priority in the S&P daily. The overhead supply is there. Financials are confirming that at the sector level there's overhead supply. Let's move along to discretionary. I mean, you tell me, is there an opportunity for a lower high here? Absolutely. Intra-week, does it align with the idea that maybe we see a counter trend first and then there's some potential rejection here at 219.75? Absolutely. I think all of this is making sense. Let's take a look at semiconductors. What do we see here? We've finally broken from this dreaded balance range on the even like a monthly balance range, right? We finally broken below. Counter trend move sets a lower high under 237. What does it imply for the S&P and the NASDAQ, right? I think the writing is sort of on the wall in terms of what the next steps are here and the implications. So industrials, anything, lower high, right? Equal low on the table. This is a lower high from here to here already. It doesn't seem like we have the most bullish looking chart here in front of us. Let's move along to the XLK. Similar comment to, of course, the SMH. Here's your multi-month consolidation. Here's your big lower low. Any retest lower high. Yes, we can get a counter trend through the two equal highs to get there. Excuse me, but any retest lower high underneath 226.85 daily 200 SMA, leaving all of this as overhead supply, starts to look a little rough, right? And that's where you're looking for that downside move. The next quote, Big Short, the next Michael Burry, is available for the S&P. Hopefully we've got someone with that title and thumbnail for today. Let's take a look at the utility sector. If it can hold up here, great. Higher low, lows, higher lows, higher lows. But what is this? This is defensive. It's the most bond-like sector. It's not really helping the bullish argument that the S&P is going to recover and go to all-time highs. Materials, really lightweight sector. It's all over the place. It's very volatile over the last couple of sessions here. So I would just watch for the resolution more firmly of this box. We tested above and failed. We tested below and failed. Sideways here is not going to move the needle. It's the lightest weight sector. Communications, possible weekly higher low on the table, but if it fails again at 102.70, it would just cause more concern. So out of this one, I would say that this is maybe I'm more open-minded to this recovery out of communications than I would be out of something like the tech sector or the semiconductor ETF, right? So there's that. TLT, just to check in on bonds, reasonable pullback after blasting off to a major higher high on a risk-off rotation, right? We've been talking about the outperformance here, so it still suggests risk off. If it catches for a higher low here at 89.75 on the gap fill reversal, it's nothing more than just exactly that, a higher low in the trend count. Maybe you build out a higher time frame weekly inverted head and shoulders, in which case something that looks like that, very concerning for the market. Consumer staples, D for defensive, it's doing all right. It's not the worst thing in the world. It's really more so sideways, putting in this consolidation up here. So we'll give credit where credit is due. Good job, bulls. You're taking a little stand here out of consumer staples, but it's not going to move the needle for the big old S&P 500 as a conglomerate. Let's take a look at some of the ratio charts. If you're not familiar with the ratio grid, you can check out the video tutorial in the top right-hand corner. This still looks like an issue. This rolling over is like do or die right here, right now, out of financials on the relative chart, right? It needs to see a higher low after breaking out to this higher high. If we come back down underneath the breakout point, that would be a red flag. So for now, we'll call this an X and we'll call this a neutral point. This is D for defensive, so I would side with neutral over here, and this does not look encouraging out of discretionary. It's in a downtrend underneath a downward sloping 50 SMA. This is looking all right. We'll put a check mark here in the XLC. Let's say that this is no good. That is a risk-off posture, as is this here in utilities. And so overall, I'm seeing many more X's and squiggly sideways tildes than I am bullish check marks. Let's take a look at the risk-on, risk-off specialized ratios. This looks like an X to me. This looks like an X to me. This is an X, this is an X, and this is an X over here on the ARK-K. Does not look like a risk-on rotation is trying to form in the S&P 500 for a reversal here. Let's jump on into our Dixie. Big breakdown on the dollar index back inside of this range here. Of course, on all the tariff headlines, that's where you're seeing a lot of this volatility come from. Generally, this should help, stocks move in the upward direction. Equity prices should increase based on the impact here to the earnings yield, but we are not seeing that. So again, starts to bring out some of those recessionary issues where, and the tariff concerns as well about did things go too far, right? So there's your Dixie. Let's take a look at rates. Let's go gold actually first, because I think this helps with the risk on, risk off narrative. If we do something like this, any higher lows here persist after a higher high, still looks risk off. Flight to safety in the yellow metal, hard assets taking a hold here, not bad. Let's take a look at, I'm interested to see what copper futures are doing. Let's go copper. Can we get copper futures? Is it HG? Ooh, let's see. How good is yeah, there it is. How good is the futures knowledge? Not bad. Not bad. This is still the gold ratio down below. That did not update, but I wanted to take a look at copper moving in the upward direction, just to see if this is inflationary at all. Copper's obviously in everything, so a little maybe counter to the XLE conversation that we're having over here. I wouldn't say that this is quite a flight to safety, but maybe a little bit inflationary. Just something to keep in mind. Let's move on over to rates now and see what's going on from that perspective. Little counter trend happening here, but nice to see the mortgage demand headline stepping up this morning, and people actually taking advantage of rates coming down. And this to me helps the argument that if rates came down like this and there was no bump in mortgage demand and people weren't actively out trying to get deals on homes, that's duck and cover, run for the hills. Nobody has any money to spend on anything. The fact that mortgage demand did see an uptick on lower rates tells me that people still have cash and they're waiting to buy, and it's not doom and gloom. We're headed for this nasty recession, on our doorstep right here, right now. We could get to that in the future. I'm not saying that's not off the table, but as of right now, not the worst thing in the world. Let's jump into let's go inverted ZT for the 2-year, a little bit of an uptick here, but overall it's fallen off of a cliff. As we know, this has been reflected over in the Fed Tracker tool by suggesting 3 rate cuts now for 2025. If we do something that looks like this, you can see here's 1, here's 2, here's 3 by the end of the year. And with small caps moving in the downward direction, that is our red flag that we've been paying attention to. Let's take a look at the economic data that's come out so far this week. It's nice to see manufacturing PMIs from the ISM report in particular holding up here over 50, expansionary still. That's obviously helping the case that we're not quite in a growth panic yet. If we take a look at where is today, here it is. The ISM services PMI number came in above the expectation, which was really important here in particular because of how the previous came in underneath the expectation and also underneath the 50 mark, indicating a contraction. I think that's sort of what started to spark some of the fears about like a slowdown in growth. And now it's actually starting to come back in the upward direction, which I think is helpful. It's putting some of the growth fears to bed. I still think that there are some structural issues with the market overall, and we have not resolved those. So it's not like one report here puts the whole recession narrative to bed and it goes away, but it's something to be thinking about. The other big one is the ADP non-farm preview came out this morning at a 77,000 versus 141,000 expectation, almost a 50% miss out of the ADP non-farm. It's still a positive number, which is good, of course, but the big full Monty labor report will come out on Friday, and we'll be watching for responses from the market to the information that comes out. The market did not really move on the ADP non-farm release, and with such a large miss in terms of magnitude, I would have expected a stronger reaction from the market. The fact that it didn't happen almost makes me seem like the market has priced in the fact that the jobless claims came in at such a big miss in the last go-around, right? And the market can sort of sense that, yeah, we're expecting some weak numbers here from the job side of things. We're expecting things to get maybe slightly worse on that Friday session. And if the market has taken a stance to price this in to some degree, I don't think that we should be shocked when on Friday, if on Friday, we see weak numbers and the market hardly budges, right? So there's that. Powell speaks on Friday. It's something to be aware of. 12:30, keep an eye out for it. But at 12:30, hopefully you're already starting to think about how you're going to enjoy your weekend. Here's the GDP Nowcast, absolutely falling off of a cliff. We did a little write-up report on this in the weekend newsletter. Hopefully you enjoyed that. And if we take a look at the subcomponents, the biggest reason, of course, being the tariffs and the reciprocal tariffs causing a huge hit here to net exports down as I hover my cursor. Look at the last, if I move my cursor, it's going to disappear. Maybe it will. Yeah, there it is. Look at one of the last line items in this box as I hover, right? Net exports down 3.29% on that particular reevaluation, which was February 28th, last Friday. We will get a new print on, I think it's tomorrow. New print tomorrow. Where is it? Yes, Thursday, March 6th. There it is. New print tomorrow to account for the PMIs that came out today by the time you're watching this video. Here is the earnings calendar. CrowdStrike on a big miss and, of course, falling in the downward direction there. Marvel is also down last I looked in the post-market. That has some implications for the semiconductor sector and I think also ties into the bearish narrative we've had thus far. The big ones that we'll be watching for is Thursday, actually tomorrow. After the close, Broadcom and Costco are your next and sort of finals for the earnings season here as we kick off the month of March, and then we'll go on pause for a little bit earnings-wise, and the banks will kick it off in mid-April, I believe. Let's go back on over to the platform here and jump into our risk on and off charts, more supporting evidence. This continued uptrend here, or at least counter-trend move relative to the major trend, but certainly off of the lows if we zoom in, right? You have lows, highs, maybe higher highs. This is definitively a higher high. It leaves plenty of room for a higher low. If this catches and hooks, you know the drill. That certainly speaks to the recession narrative. Let's take a look at the bonds relative to themselves. I don't think that this tells as much of the story as what we need to pay attention to. It definitely suggests that the shorter end of the curve is not getting as much love these days. The longer end of the curve is where we're seeing all this impact. And I think rightfully so, right? The Fed's not going to come out and say like, hey, a recession's on our doorstep, let's drop the short-term rate immediately. The longer-term rate is sort of doing the work of the Fed as of right now. So that's the interpretation there, at least from my part. As we look at credit spreads, a small expansion here. We sort of said in the weekend video that we'll be watching very closely for the HYG, the junk bond side, to make a move, and so far it hasn't. So watching this closely, if this just remains muted and this fades back off to, very comfortable levels underneath the 50 SMA, then fine. Maybe we do have to reevaluate more of the stance for a stronger bottom out of the S&P if credit spreads can contract a bit here. Let's move into the HYG in isolation. Finally, starting to break down here with the S&P. So we'll see. It still has a higher low. You could technically draw in a divergence from this perspective and this perspective here. That is on the table. It's in the cards. But you also have on the immediate term confirmation out of HYG. Let's check in on LQD, which of course is corporate grade in isolation. plenty of room here for a higher low. This is maybe one to keep an eye on. If this uptrend can persist, if we can keep a higher low out of the corporate grade side, that might be a stronger indication to be a believer, right? If this holds, let's say H for holds, if this holds and, right, it has to be both, and there's a reversal in the S&P 500, maybe be a believer sooner rather than later in that reversal. Okay, so a little bit of a supporting evidence piece there for the buyers. Bitcoin, what's going on with the digital gold over here? You can see that we are not quite through the signal line yet for the Sailor Shift tool, but we are right back at the bottom end of the balance here. In my view, this is a better short opportunity, risk reward wise at least, for something along these lines than it is a long opportunity. I would really think, regardless of the reserves and the crypto reserve and all that being announced, I would think that the stronger opportunity is a lower high gets set and people who are long late to the party are still disappointed looking to exit. The next strong buy would be on a firmer retest of the 71.5 level in my view. So it's got to get there. It's got to get there, and we're not there yet. Let's keep this thing moving along. What do we see out of breadth? Still contracting. You can see a big downtick out of the 200 SMA and the 50 SMA. That's the green and blue line, respectively. Small uptick relative to the previous week on new highs versus lows, but undoubtedly still in negative territory. Breadth contraction here that is bearish. Let's take a look at the RSP. It has undoubtedly broken down through the key level that we were watching. We were saying, hey, if this consolidates up here, then maybe we do have breadth stepping up and fine. We can catch a rally off the bottom end of the balance. But with the breakdown here, it does not strike me that we have a broadening nature of the market rally. Let's take a look at, we could go QQQE real quick as well, failing underneath its key level. And of course, the transports are going to look horrid here, making a big time new lower low relative to industrials up here. That, of course, has been divergent for a long time. VIX has spiked a little bit over the 2050 mark, but nothing where I would say like major capitulation. Oh my goodness, it's the big low. Look at the yen carry trade explosion back here. We want to see like 30 plus VIX. This is like a good start, but it's not really total capitulation. We're getting close with all of the sectors, most of the sectors, I should say, red, but we're not fully there yet. And you can also see this through as we take a look at the VVIX. No major capitulation spike here. Yes, we're over the 120 by a hair, but not much. And the only thing that starts to suggest, oops, we just loaded that chart. The only thing that starts to suggest that we are close to a capitulation is just the fact that volatility futures have actually gone into backwardation. If you look at the white line here, and you can even do this representation for anybody who maybe missed the Saturday update, you can find the same thing over here through the Thinkorswim platform. You don't need my fancy little study there. You go to product depth, type in the volatility futures /VX, go to product depth, hit futures, make sure you're looking at all of the expirations. I believe, where is that? You can hover your cursor here, show 8 series, and this will show you your futures curve out of vol. So today, this was much more extreme, and you had something like near-term vol up here. You had next near-term, right? So you had this inversion of the curve that looks something like this. A normal curve is like that, where we have, volatility in the present day much lower than unknown future, unknown future, unknown future. So we're starting to get back into a contango here. The volatility futures obviously opened back up. So we'll see how this persists tomorrow, but we did fall into backwardation, which is noteworthy. It starts to suggest the beginning of capitulation. We're not there yet. And as seen in the other vol indications, I would not make the call that a capitulatory bottom is in force. But this is the beginning stages of maybe we're getting to that point. It's closer rather than further away. Versus, at the beginning stages of last week, a week ago on Monday, right, we were much further away from saying, hey, there's outright capitulation. I think we actually warned of this. We said volatility has not done anything yet. Like, buckle up. You haven't seen anything yet. I can go back and I can find the quote probably and paste it in the video. I'm not going to do that. Who has time for that on a Wednesday night? I don't, and you probably don't either. So let's get through the core list of companies. Let's get you out of here with a couple of trade ideas, 3 of them to be exact, and then we'll trade the rest of the week. Let's see what's on tap. Here's NVIDIA. Why are we bearish the broad market? Because there's so much room for a lower high underneath 129 to keep all of this as overhead supply. You have highs, lower highs, lows, lower lows. Lower high keeps the trend down. You have a rejection of your daily 200 SMA, daily 50 SMA, 129 is the big level. I do really like the opportunity out of NVIDIA for a counter trend move early in the session on Thursday, so long as we can open in here. Where are we based on Marvel's earnings? 11670s still puts us over the 115.50, which is important from this previous low. As long as this consolidation is in play, I would be thinking this is a top-of-mind idea for tomorrow. It was a top-of-mind idea for today, but the market went sideways all day. So this persists into tomorrow's session. Consolidation, Brigade bullets over 119, counter trend longs up to 125.25, and then 129. When we start getting towards this zone, I would put my thinking cap on and I would start suggesting, or wouldn't say suggesting, but I would be looking for that lower high opportunity. All right, that's that. Moving along to Softy. What do we have out of the daily? I think it's really important to consider the daily charts, especially given what's been going on here. Big breakdown, strong opportunity for a lower high underneath 403. Yes, you saw a stronger move to the upside out of Microsoft on the intraday during today's session, but there's still so much overhead supply here. There's still plenty of opportunity for a lower high to be produced off the retest at 403.25. So I'm still mostly interested in shorts out of Microsoft. A straight up move today. I think it can be retraced. So early on in the session, I would love for tomorrow to open over. There's a number of ways to trade this. My favorite setup for tomorrow would be an open on a gap up that's over 403.25 that fades to close the gap, rallies for a gap fill reversal, and then rejects hard for a lower high on the reattempt of 403.25. That would be like a golden ticket setup, in my opinion, based on the daily time frame chart we were just looking at. Risk, reward here totally plays in confluence with the setup from the daily, right? Seeking that lower high. So I would prefer that. If we open here, rallies that, reject, great. You could offer the same risk reward, but it would be best, in my opinion, to get a gap up to sucker in new money longs, right? You want to put as many people off sides as possible. Longs late to the party here, longs buying this on a gap up. If you sort of break their dreams by suggesting the lower high under 403.25, that's your stronger short side move to here, and then possibly looking for continued thin structure retracement. 380, excuse me. Time to end the show. 389.25 on the downswing. If we get acceptance over 403, let's say there is a gap up or something like that. If there is something that looks like this, of course there's no short. Like, we're just patiently waiting for the next setup. If we open down here, we talked about rally attempts. If we just get this Brigade bolt, also an opportunity to the downside, this would just be the lower high. Next up, Apple. This chart throws me off. Really don't like the phantom bar that sort of printed on the end of week session last week. I don't like the overshoot, how it went through here, but sort of supported off of a prior technical level that we were using from the top of this range, right? Top in here, sort of got some consolidation above, lower high underneath, pull back, open over here. Right to it on the phantom wick, and you also have this low of today's session. Really funky price action. Undoubtedly a daily hammer in here if you were just to draw in the daily bar over the hourly chart. Something that looks like this is a possibility, but is the long clean into this overhead chunk? I don't think so. You could try it on the long side, but I think NVIDIA is a way better counter trend long opportunity than something like Apple, so I'll leave you with that. Amazon looks pretty good let's go to the daily here. For the counter trend as well, setting this lower low, on the daily trend count at the daily 200 SMA. If you get some follow through here, you're just looking for another lower high opportunity at 219.25 that played out quite nicely into the end of last week. We'll see if we can rinse and repeat that trade off the level to keep these traders underwater on the long side. The hourly chart pullbacks here, I think that sets you up. That sets you up to get there. If it's just an opening drive bull flag with a 5-minute higher low Brigade bolt over, now you can start to look for this thin structure retracement from off to the left. So the counter trend is there. As mentioned in the intro, I think the counter trend is absolutely a possible outcome into the late stages of this week. It's just a matter of spotting it and not overstaying your welcome on it, as noted also. Here's Google, stuck on the lows. Another opportunity for a counter trend, just noting that any shorts who are continuing to pile in on the lows are not being rewarded with lower lows. You're also approaching a sort of chunk of value down here where you can see the inverted head and shoulders. This is way long ago. We're over that neckline. So if this can support, I do think a counter trend is available, and there's plenty of room to retrace the thin structure to the upside. So that's 182.50. When we get there, that's where it's okay, reevaluate. Do we have inverted hammers? Do we have an excuse to be looking for lower highs there? Is there the possibility for a stronger short back to the downside, right? So that's Google. Metaverse. I like Meta on the long side for follow through after the hammer here. Close over the 50 SMA today. I think that it can see continued upside here. And one of the things we've been talking about in the pre-market shows is just if you look at the previous price action of Meta, it's a much stronger name than like 90% of things that we've looked at so far. There's a strong uptrend back here. Look at the spread between the 50 and the 200 SMA. Look at the retest, like weekly Brigade Bolt off the breakout level back here at 635.25. I find it more compelling on the long side. So on the hourly chart, I think that I think that the opportunity is a pullback that supports 648, looks for longs to here and continuation there. If we get a Brigade Bolt over this level, just making a move back up to these equal highs at 682.25. I would have to change my tone to being more cautiously bearish if we get down here and are accepting underneath 648. So that's kind of my over and under into the late stage of this week. Next up, Tesla, the fan favorite Tesla. You've got to keep that higher time frame perspective here. You're coming into the retest level from this point of view, massive retest down here. It makes sense that this could try to catch itself for a little bit of support near the 200, near this area that caused the prior breakout, gap close area as well. If we can see this follow through, I think there are some easy, you guys, if you've been tuning into the pre-market shows, right? Easy exists on a spectrum. You have easier and harder setups. You don't have trading as easy. You have easier setups to watch for and more difficult setups to watch for. That's a weird looking D, but you get the point. The Tesla setup here is if we can get this consolidation, I think the easier trade to watch for is over 293.50 starts to establish this rounded base low off of the major daily level we were just exploring, right? You could see that here at 265.50. So that's my top watch, 293.50. Any consolidation here starts to build the base, and then let's see if we can finally make it happen. Failed gap up on the Monday session, did not really offer gap fill reversal, enough so to get through and into some of these thin structure zones that will be quite lucrative to trade through. So could it be a inverted Man Ray pattern? Absolutely. We've just got to let it play out. We've got to see that resolution of 293.50. Next up, JP Morgan. Weakness in financials we saw at the sector level. As we look at the individual chart inside bar today, I think that there's lower high opportunity here. Find a rebound off of this, fine, but it's nothing more than a lower high under 260.60, keeps the bearish pressure on, and that's no good. Netflix continuing along, it is the head and shoulders, we're watching out for it, right? It's not in play yet. Under the neckline gets interesting, that's into the earnings gap, that's under 950.25, not in play yet. And if we do see a break over the right shoulder, just like all the other names we've talked about, a counter trend could be in the cards. I would be looking for a lower high back here, right? The only thing that you could sort of think about is the much higher time frame chart, like the weekly. This is the only thing I think that maybe is compelling out of Netflix. If you go to the weekly, you can see here, right? This is a classic weekly Brigade Bolt. Now, of course, what does this imply? Your time frame of analysis needs to match your time frame of execution. If you're trading this weekly hammer, you better be willing to say, okay, I want longs over this hammer high. I can't really target just the all-time high because I probably have to put a stop here. That's 1-to-1. You're basically needing to hold this for a blue sky breakout. If you want to trade that higher time frame idea, be my guest, but you can't sit here and say like, oh, I'm trading this hammer, but I'm stopping out as soon as price is back under $9.99. You never gave the setup a chance to play out, right? So those are my words of wisdom, if you even want to call them that, on Netflix in terms of the chart pattern in force there. I'm a little cautious of the long. I think that it can play, and if it does play over time, like fine, maybe there's some long scalps from A to B, and then we'll reevaluate here, and we'll say, okay, do we go back to the high, so on and so forth, but we're not there yet. I do think that this is a bit more compelling than some of the other tech names we've looked at so far, holding over the daily 50 SMA. I don't think there's a single other name here that is holding over the daily 50 SMA. Apple, no, wasn't over the daily. Let's hear Meta a little bit, close, right on it, right? So you can sort of see what I'm driving at with that Netflix relative strength. All right, 3 trade ideas, then you're out of here. What's going on with Airbnb? ABNB is the first one. This is a higher time frame idea where it's possible you start to see a short squeeze out of this range, right? Anybody who's diabolically short this name, like, oh God, Airbnb is going to go out of business, it's back to hotels, right? Which is probably more of a common thought process than not these days. But any breach of 145, I think you have a thin structure retracement, short squeeze, and you sort of get the hold of this zone of value down here. So Airbnb over 145 targets 152.85. I want to see the continued consolidation over 140.75. Here it is on the hourly chart. You could get crazy. You could start to draw patterns. You could draw whatever you want, but you could just see where the shorts start to squeeze. Anyone who's short here, anyone who's short here on the lower low underneath that prior day's range, anyone who shorted this gap down, right? these people start to get real into panic mode over that 145. So that's Airbnb. That's your first long trade idea. Next up, we have a, what is this one? DDOG, Datadog. And if we go to the daily, it's another example of a potential short squeeze, right? You have all these shorts. Notice the incremental lower lows. This is one of the things, that I think is very important. Lower low, lower low, incremental lower low, incremental lower low. Anybody who's shorting this late to the party after the majority of the move to the downside, you're not being rewarded. Put yourself in the shoes of a seller down here. You've established this big short position. Okay, today's the day. It made a lower low. Okay, no. Today's the day. It made a lower. Go. No. Okay, you close at the high. Oh, we made another lower low. Great. Again? Really? Again? So if that's what the sellers are feeling like down here, what is it? What do they do when you're over 117 and this starts to accelerate? They squeeze out. That's the whole premise of a short squeeze, right? So maybe a good, visual example of that, as well as uttering those words, oh, it's going to go, right? And that little glimmer of hope, the hopium trade, as noted in the intro as well. You're looking at 126.15 upside target through the thin structure, obviously, on that breakdown from Friday of 2 weeks ago now. Last trade idea for you after DDOG here is on another fan favorite PLTR, Palantir. Give me the long, show me the hold of this level. You could start to see how this is inverted Man Ray pattern. If you're over the neckline 90.80, thin structure retracement to the low end of the earnings gap up range, $100.50. And Palantir is back off to the races. It's got that cult-like following. Everybody loves Alex Karp and all of his crazy words, words of maybe their wisdom in the earnings call. Here it is on the hourly chart, right? Oops, zoom in a little bit more. Pattern-wise, inverted Man Ray. Even if you don't subscribe to the inverted Man Ray idea, call it a double bottom, call it a neckline. Doesn't matter what you call it. The premise of any pattern is that it describes a trend. When we bring in a higher high, the hourly trend is starting to flip to up. We have lows, equal lows, highs. If a higher high produces itself here, higher lows send this back up to the next structural element, $100.50, and that is your possible trade here out of Palantir, risk, reward on the upside. Reevaluate, absolutely, when we get to $100.50, but that is the premise of the trade idea. And that's what I've got for you in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a simple thumbs up. It seems like we struggle with that every morning up in the penthouse office. In all seriousness, we'll see you back in the office tomorrow morning, 8 o'clock Eastern time sharp, for our jobless claims. We'll see how the market reacts to that. And of course, we'll do the show live on the Friday session, as we always do, but we'll have coffee and donuts, especially for the full labor report. Come on out to the show. We're live every morning here on the channel, 8 o'clock Eastern time. Come build a game plan with us for the pre-market into the early morning session, and we will set you up for success on that day. Let's finish the week on a strong note, first week of March. I hope you have a fantastic green rest of the week, and I will see you in the next one.